Good afternoon, ladies and gentlemen, and welcome to the Watkin Jones PLC full-year results for the year ending 30th of September 2023 investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time using the Q&A tab on the right-hand corner of your screen. Simply type in your question at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today, and we'll publish those responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'm sure the company will be most grateful for your participation. And I'd now like to hand over to CEO Alex Pease. Good afternoon.
Good afternoon all, and thank you very much for joining us. As discussed, I'm now going to present to you the financial results for 2023 for Watkin Jones Group. I'm going to be joined in the presentation by Sarah Sargent, our CFO, and I'll just move on to our agenda. So the agenda for this morning will begin with a short overview from myself, reflecting on the last year before looking at some of the key focus areas for the business as we move forwards. Sarah will then take you through the FY23 financial performance and the outlook for FY24, and also touch on our progress with ESG and our Future Foundations programme. I'll provide an update on the market and the robust fundamentals supporting the sectors we operate, before taking some time to review some of the areas and opportunities where we believe we can broaden our resilience, adaptability and earning potential as a business. The presentation should take 35 to 40 minutes, and then we will open the floor to questions. So moving through to the FY23 overview, I think it won't surprise anyone, 2023 represented an extremely challenging year for both the wider economy, UK real estate generally, and also the Watkin Jones business. Significant headwinds disrupted many areas of our operations, with the impacts of inflation still pertaining and disrupting bill costs and supply chains, and the high interest rate environment driving debt and gilt rates and causing dislocation in liquidity of investment markets. The business was able to marginally increase its revenues in the year to 413 million. However, operating profit was severely curtailed at a break-even position on an adjusted basis. In the year, we took an additional provision of 35 million associated with the building safety, and Sarah will touch on this in more depth later on. However, FY23 was also a year where the business has continued to demonstrate its resilience and adaptability. At the close of the year, we were able to report a positive gross cash position of 72 million and net cash of 44 million. Our capital-light business model continues to provide us with low levels of debt and good visibility of earnings, with over 500 million of forward sold revenue secured over the next 3 years, 300 million of which will come through in FY24, which covers our overheads for the year. The business has continued to deliver operationally, practically completing 5 assets in 2023, and also achieving investment sales across all of our specialist sectors. With the wider macroeconomic disruption largely outside of our control, we had an absolute focus on the business itself, looking to make sure we were as fit and well positioned to capitalise as the market cycle begins to rebalance. We've been on the front foot, ensuring that our organisational structure and staffing are lean and efficient without looking to inhibit growth as we see that market change. On the flip side, we've also tried to ensure that we have the right incentivisation strategies in place to retain and motivate our key staff. We've worked really hard in actively managing our existing pipeline, looking to improve the viability of assets through design efficiencies, increasing the scale and massing of developments, and also through renegotiation of some of our contracts. We've also managed to remain proactive in the land market. We're beginning to see some more value emerging as the forecast lag stemming from the investment markets starts to filter through into land. We're also beginning to recognise benefits of a series of operational initiatives, including our centralised procurement strategy, where we have agreed over 40 new partnership frameworks in the last year alone, and have undertaken considerable rationalisation of our supply chain. We've also launched and implemented a new design standardisation across all of our product lines. This is really looking to enhance our build and material efficiencies on our sites. But looking forwards, since my appointment as CEO in November, I've had the opportunity to take stock of the business, the markets we operate in, and where we see the opportunities for Watkin Jones going forward. My first reflection focuses on the strength of the Watkin Jones business. A highly challenged market has not diluted our market-leading position, nor does it dilute our core strengths, expertise, and differentiators as business. Watkin Jones offers what most of our competitors cannot: a true vertically integrated business which has deep expertise and knowledge, not just across the residential sectors, but also across the entire development cycle. The ability to originate and acquire sites, navigate and unpick planning potential, design and deliver buildings, operate and create communities, and transact and partner with institutional capital. This enables us to unlock value at every stage and pivot and adapt the business to react to changing market circumstances. Personally, in the next 12 months, I think some of the most important factors affecting the market will be, firstly, the ability to form partnerships with capital, to create deals in an evolving market where flexibility, creativity, and track record are absolutely key. Secondly, the ability to deliver and de-risk construction for investors, absolutely crucial in an environment where third-party contracting has been put under severe constraint and appetite from direct development exposure from wider investors is on the decline. Lastly, the absolute knowledge of the customer and the product and how to differentiate yourself in the market and how to maximize your assets' performance. I think it's this alignment with our core business strengths which sets the platform for a positive look forward to the market. Of course, the wider operational market has a significant part to play in a positive and medium-term outlook. The residential for rent markets of PBSA and build to rent have shown exceptional performance through the challenged economic environment of the last 18 months. In the market review, I'll talk through how this performance fuels confidence in an investment recovery, of which there are some early signs of liquidity returning to the market. We have confidence in the operational strengths of our business, the continuing supply-demand imbalances, and the positive sector performance will continue to fuel investor demand and our forward fund capital-light model going forward. However, we are also looking at potential opportunities to maximize our expertise and knowledge and also broaden our potential income streams and add further resilience and adaptability to our business. I'm going to talk through later just some of those near-term strategies which we think are quite interesting, development partnerships and a redevelopment model. And we're also going to touch on some potential longer-term options to add incremental asset management benefits and fee income to the business. I'm now going to hand over to Sarah for the financial summary.
Thank you, Alex. Good afternoon, everyone. I would like to take you now through the financial highlights for FY23, review our market guidance for FY24, and then consider what an illustrated recovery profile of the business could look like. So for FY23, I'm pleased to report that overall our results are in line with our October trading update. We've reported strong revenue of 413 million, which includes the forward sales of our student scheme in Bristol and our BTR scheme at Titanic Quarter in Belfast. Importantly, this was a small increase on FY22. Our gross profit was at 40 million compared to 68 million in the prior year. The decline was predominantly due to lower levels of forward sale activity, additional build costs at our site in Exeter, where a main contractor went into liquidation, and some acceleration costs we experienced for schemes which completed in the summer. Gross margin percentage was at 10% compared to 17% in the prior year. We took decisive action during the year and reviewed the balance sheet with the overall aim of recycling cash back into the business. We disposed of 3 non-core PRS assets. This recycled 11 million cash, but crystallised a book loss of 4.6 million. We also exercised discipline over our land bank and pipeline. We reassessed the carrying value of certain non-core land bank assets and pipeline WIP balances, resulting in impairment of 5.5 million. Subsequent to the year end, we've realised cash of over 1.5 million from disposing of some of these non-core assets. We continue to work through further opportunities. Furthermore, as Alex has alluded to, we faced into the challenging market by carrying out 2 overhead efficiency exercises, which realised run rate savings of circa 4 million. Adjusting operating profit for the year is at break-even, although importantly, you can see here that we've achieved a core trading operating profit of 10 million before the land impairments and book loss. This next waterfall slide reconciles our previous full-year guidance, indicated by the blue block on the left-hand side, to the final position for FY23. Overall, 7 interest rate rises over the year and the wider macroeconomic picture have effectively curtailed the forward fund market, with only a small opening in the early summer where we managed to transact on 2 schemes. The most significant movement, therefore, has been a loss of margin from the development pipeline. Of this significant chunk of loss margin, 40% of it will potentially move into FY24 with the schemes we have in the market, and 30% will move into FY25. The remaining 30% of it has been lost due to change in pricing and some developments we've not pursued due to lack of viability. The other blocks set out the key movements that I've discussed, and you can see the benefit from the efficiencies that we've implemented. So overall, while this results in a minimal operating profit for FY23, the actions we've taken serve very much to set the business up for the future. From a cash perspective, we had an operating cash outflow of 32 million, predominantly reflecting investment in 2 new land sites and spend on our remedial works. Importantly, our borrowings remain flat year on year. With gross cash of 72 million and the headroom we have on our RCF facility and our overdraft, we have cash and available facilities of 104 million. We extended our RCF during the year with HSBC to November 25 to allow the debt and forward sales markets to stabilise given the current volatility. Again, we've been financially prudent, taking the decision to reduce the facility to 50 million from 100 million. The 100 million was taken out at the start of COVID, and we simply have not used it. Our average drawdown over the last 3 years has been 28 million, and we'll realise a significant saving on our non-utilisation fee. The board has made the decision not to recommend a final dividend in respect of FY23, given the uncertain market backdrop, but remains committed to a progressive dividend policy as earnings recover. We have maintained a strong cash position since the half year, despite the challenging market conditions and delays in our anticipated forward sales. This slide bridges from the full half year to the full year, and you can see the significant movements of 11 million net investment in land for 2 student schemes in the south, where we've received planning consent. We have carried out some enabling works on these schemes we have in the market to ensure that build programmes are maintained. And then you can also see the cash proceeds of 37 million from the 2 forward sales we completed during the year, as well as the PRS properties I referred to previously. Now moving on to the balance sheet. Land and work in progress has decreased as a result of the disposals and the impairments taken. While there's been a build-up of contract assets, and this is evidenced in the increase in receivables, this is predominantly due to an increased contributions from the 2 BTR schemes and 1 student scheme which were physically complete in the first half. These will unwind in H1 on completion and receipt of the associated bullet payments. However, the key movement in the balance sheet is the additional provision of 35 million we've taken for building safety, offset by the spend on this during the year. Our net provision is now 55 million. This is made up of a gross provision of 66 million, offset by client contributions of 11 million, which have been successful in agreeing to mitigate this cost. So just touching further on this provision. So we've recognised a further exceptional provision of 35 million. This has been recognised as a result of an introduction of secondary legislation during the year and evolution of government initiatives. We've also experienced change in scope and cost estimates following intrusive surveys and fire safety reports on the properties which were included in the provision last year. And finally, we've continued to negotiate with our property owners and have agreed a level of settlement contributions on a number of properties. The provision contains an appropriate level of contingency. And we are continuing to explore additional recoveries, for example, from further down the supply chain, but we obviously cannot recognise these at the moment. From a cash flow perspective, the provision will be spent over up to 5 years. This next slide sets out the movement in our NAV since the prior year end and the half year. The key reasons behind the NAV decrease are the additional building safety provision and the 10 million impairment and book loss we've realised. There have been no other fundamental movements, and we set out in the appendix a more detailed breakdown of this NAV movement. So now moving on to 24. In terms of our 24 operating profit outlook, the key point is there's no change to our previous guidance, which we set out in the summer and reiterated in October, of operating profit between 15 million to 20 million. This slide demonstrates that we have positive potential operating profit without doing any forward sales. This is made up as follows. Our forward sold revenue, which is contractually secure, of approximately 300 million at circa 10% gross margin. The gross margin contribution from our fresh business, offset by our overheads. The operating profit to be secured, illustrated by the shaded red block on this chart, can be made up from a combination of the 4 sites which we have with planning, which we're currently being marketed. One of which is in legals, as well as further secured sites where we're progressing with planning for potential forward sale in the second half. However, of course, we do need to be cautious and acknowledge further market pressures as we look forward into the year. Looking forward, this slide gives guidance to our secured half-year cash position. The key point here is we have a significant unwind of the working capital in the form of final bullet payments for schemes that we will have completed in Q1 and Q2. These amount to circa 25 to 30 million. This, combined with minimal working capital outflow on the live schemes, will give us a strong secured cash position at the half year without any further forward sales. So moving on to the longer term outlook. How do we see the business recovering over the next 3 years? Well, we have strong confidence in the rebuild to good levels of revenue and profitability. This slide shows an illustrative recovery profile for the business. If the market recovery meets our expectations, we have the building blocks for a circa £500 million revenue business at 12% gross margin in FY26. This is anchored on our level of forward sold revenue of 500 million, which is shown here in the beige boxes, which will be recognised over the next 3 years. In addition, we have the 300 million of revenue of schemes that we have in the market, and 700 million of revenue from sites which we're secured and currently working through planning. And we are currently looking to secure schemes worth 400 million. These are currently under offer or working through legals. There is still some drag on margin from the schemes we sold in the last 18 months, which will continue to impact to FY26. But the margin on new assets will build back to a more normalised position, giving us a blended 12% in FY26. Key to point out that this slide just represents our PBSA and build to rent and affordable homes pipeline. For modelling purposes, you need to include the additional gross margin from fresh. However, this shape is obviously indicated on the recovery of the market, of which there are now early supportive signs, and Alex will cover this in more detail later. So now look at Fresh, our accommodation management business. We continue to view Fresh as a key differentiator and part of our end-to-end proposition. The performance in the year was solid. There was some impact as expected growth didn't materialise due to wider economic factors. The business did experience strong retention, and this resulted in the units under management being relatively flat on the prior year. The operational performance was excellent, with an occupancy level above 97% and rental growth on average at 7%. Our focus on the resident experience remains paramount, with our wellbeing programme a fundamental part of the offer. Fresh achieved a student net promoter score of +35, and the business has also been voted best private housing provider for the 3rd year in a row by the Global Student Living Index. Looking ahead, we currently have a pipeline of 7,000 units, which will come through either as a takeover or as a new build. And just like with Watkin Jones, we're looking at ways we can enhance the revenue from Fresh. For example, how services can be extended around the management model. These can include design advisory, lifecycle services, and a white label offer. And we're also looking at innovation across the business, for example, dynamic pricing, which you've seen can lead to a 20% rental growth, and the use of AI to support our bookings and marketing. Finally, I'll just touch on the progress we've continued to make across the 3 pillars of our ESG strategy: people, places, and planet. Our health and safety performance has been excellent, with an incident rate 4.9% of the national average. All of the sites submitted for planning in the year have been established as BREEAM Excellent, and we diverted over 98% of waste away from landfill, which is ahead of our 2025 target. Looking ahead to 24, we are working to review lower carbon products, for example, window frames, which are made for 75% recycled materials and blended concrete. I will now hand back to Alex to cover the market opportunity in more detail.
Thanks very much, Sarah. Yeah, so moving now to the market. The occupational markets across both PBSA and Build to Rent have been exceptional performers, demonstrating the resilience and counter-cyclical characteristics of the sectors. What I really like, there's a very clear logic and evidential pathway which flows from the existing supply-demand imbalances through to the end investment drivers. On the demand side, student numbers have continued to grow domestically and internationally, with numbers forecast to hit full-time students of 1 million by 2030, which is about a 230,000 increase. Build to Rent demand is being fueled by growing populations, shrinking household sizes, and changing lifestyle habits. And again, Savills came out with an interesting report last week, forecasting potential need for additional 800,000 homes in the rental space by 2031. Over the years, supply has become increasingly constrained and has not kept up with demand. This is due to a range of market challenges, including the volatile economic backdrop and the resultant viability hurdles, as well as the continued travails and inefficiencies of the UK planning system. These imbalances and shortfalls have driven very strong occupancy and rental growth levels across both sectors. This operational performance in turn has then helped support asset and sector returns. Relative to other sectors, real estate has been sort of far less volatile and has also compared very favourably in terms of total asset return. This performance then continues to attract investors to the sector. So if you look at the last 6-year trend, each year there's been increased allocations to UK residential for rent, moving out to some of the more, I guess, traditional real estate sectors of office, retail, and moving into the residential side. The culmination, we believe, is very strong support for the forward fundings remaining the key conduit for investors coming into UK residential. This driven by the lack of existing stock and failure to keep up with demand, and also the ever-increasing focus on building quality, safety, ESG, and then also another that should be underestimated, the real challenging development backdrop has deterred and put out some of the competitors, but also in particular some investors who are sort of beginning to go up the risk curve and do more development themselves. They're now rowing back from their previous development ambitions and looking to rely on people such as Watkin Jones. On the investment market side, look, in the UK, it's clearly been impacted by the volatility in the wider economic environment and increased interest and gilt rates in particular. However, the market's not binary, and despite these headwinds, transactional activity has continued, albeit on a stop-start basis as economic windows have allowed. To put it into context, in 2023, there were circa 6 billion of sales across UK Build to Rent and PBSA, and that's versus 11.5 billion in 2022. Watkin Jones have also been able to take advantage of the pockets of liquidity in the year, transacting in excess of 250 million across all of our principal sectors. As inflation is moderated, there is some growing confidence that volatility is subsiding and interest rates will trend downwards in 2024. And this is beginning to fuel an emerging confidence liquidity will return. Q4 recorded transactions in excess of 1 billion, and in recent weeks there have been announced a number of new equity entrants to the sector, which is a sign I always look for when good quality equity is announcing new mandates. That tends to be a positive read through. Certainly, we've experienced a good pickup in our conversations with our capital partners over the month of January. To help illustrate the operational model, the scale of projects we undertake, and the capabilities of Watkin Jones, I will briefly run through 2 case studies of deals transacted in FY23. The first is Loft Lines in Titanic Quarter in Belfast. This is a major urban regeneration project of 700 plus residential units, and it was the first build-to-rent scheme in Northern Ireland. Needing to prove concept to build-to-rent in Belfast necessitated an innovative JV partnership approach on a subject to planning and subject to funding basis to ensure alignment between parties and maximise potential for the site. Planning for large-scale and mixed-tenure regeneration sites creates additional challenges. However, the team were able to successfully navigate the multiple stakeholders and significant public and political interest to achieve a fantastic consent. I think the transaction really reflects the strength of Watkin Jones' track record and partnership capabilities, attracting high-quality investors such as Legal & General to a new city and market, and then also our management strengths in balancing multiple parties' ambitions in a tough economic backdrop. The second case study I'm going to talk about, Metalworks, represents another regeneration scheme, this time an 800-unit PBSA student-led scheme in Bristol. Again, I think this case study really underlines the adaptability and partnership merits of Watkin Jones. The development was impacted by the rapid deterioration in liquidity and pricing sentiment as markets changed in late 2022. WJ were in part able to mitigate these viability challenges in 3 clear steps. Firstly, strong interactions with Bristol planners enabled us to achieve design efficiencies and savings across the scheme. Second, our university relationship and track record. This significantly helped successfully negotiate a re-gear of the existing lease we had in place to enhance viability of the scheme. Third, and again, investor partnership. We had an established investment partner in KKR who contributed to an exceptional transaction, which was executed in extremely tight timeframes of 10 working days in a very brief period of relative economic stability. On the land and planning side of the business, we are now seeing more pronounced land value impacts from the squeeze on investment transaction activity and pricing. Both land transaction volumes and urban land values were down across the UK over the last 12 months. Planning continues to be a political football with plenty of rhetoric on ways to simplify and make the system more efficient, but very little action. The barriers to planning remain high, but the Watkin Jones model continues to align well with brownfield and urban regeneration policies. Our specialist team and extremely strong planning track record mean we see this as a continued opportunity to outperform. As mentioned previously, we have remained proactive and innovative in the land market, and since the year end, we've exchanged 1 new site and are now under offer on 3 other opportunities with a potential net development value in excess of 500 million. So, the dynamics and business attributes we've reviewed provide a continued confidence for us of the ongoing attractiveness of the sectors we operate and the demand and need for forward fund transactions structures through the medium and longer term. Nevertheless, with a change of leadership and a tough market that we've just been through, it's been a logical juncture for the business to take stock, review and assess whether there are other areas that we can enhance the business, both from a resilience perspective, but also potential to broaden our earnings base. With comprehensive knowledge and expertise existing within Watkin Jones across all facets of the development cycle, we believe there is the opportunity to expand the range of income sources we have and help provide a smoother underpin of the revenue and profit going forwards. So I've spoken previously quite often about our investment and partnership credentials. However, for me, it's the depth of other skill sets across the business which offer us differentiation and adaptability. In-house delivery and construction gives us competitive advantage for the group, providing us with speed of mobilisation, buying power, and additional margin contributions, as well as a control and consistency of offering and product. Importantly, it also allows us to flex strategy and entertain development partnership prospects and other initiatives with our investor clients. The centralised pre-construction and procurement functions within the group again provide the ability to move efficiently from development to delivery phases, but also give us the tools to manage third-party contracts and subcontracts, as well as enhancing our outturn cost performance through supply chain management and product design evolution. Our building improvement teams have performed an incredibly important role for the business, navigating the evolving building safety landscape. We now believe we have the chance to create an opportunity out of a challenge and utilise our specialist and really quite scarce skill sets as a key component of a refresh redevelopment programme. Finally, with Fresh, our property manager, we're able to provide the business and our clients with in-depth customer and product insight and also analytics. This allows us to offer advice and services on repositioning, branding and operations, completing our end-to-end offering. So what this diagram is sort of seeking to sort of show that currently Watkin Jones creates the vast majority of our revenue through our typical planning, development and forward fund business and through the property management fees generated via Fresh. The model has absolute strengths and has proved highly successful. However, we also think there's other options already within house that are available to us. So what we've been looking at is sort of near-term diversification opportunities. And I'll talk through these in a little bit more detail. But in essence, it's this diversification of earnings and extracting more value from our existing in-house functions, sort of looking to branch into some tangential areas of the sectors we operate and providing sort of greater spectrum and granularity of revenues, but also improving the speed of revenue recognition through leveraging of our existing skill sets into these sort of adjacent and complementary strategies. So the first of these is development partnerships. And these are something which the group has undertaken before, but it's very much more on an ad hoc basis. In effect, a partnership arrangement is between Watkin Jones and our investor clients. So we utilise the investors' capital and Watkin Jones' development and delivery capabilities to acquire and deliver consented PBSA and build-to-rent sites. So in the current market environment, what we're seeing is more scope to secure good quality consented land and a good pool of demand from investors wanting to partner with us. And as such, we think we can make this development partnership sort of function less ad hoc and more as a strategic venture. I think that the primary benefit of doing this model from a Watkin Jones point of view, if you look at the diagram, typically when we secure a site, we secure it subject to planning. It might take a few months to get to exchange, but then we could have a period of anything up to 18 months to secure planning and another anything up to 6 months to secure a sale. So potentially from exchanging contracts and securing the site to actually recognising revenue and margin on it might be 24 months. So on a development partnership, clearly one of the real benefits is you bring forward that revenue recognition by up to 24 months because you don't have the long planning process because you're buying it with the benefit of planning. So I think that's a real sort of positive, as is the fact that it doesn't ever touch our balance sheet. So we can secure margin and revenue without actually having to put any money out from the group's perspective. I think that the important thing to note here is this is not us looking to take on contracting jobs. We still very much see this as a development service, and the margins, whilst they'll be reduced from a typical full development model because you're not taking planning risk and you're not taking exit risk, they will still very much be double-digit returns, which we think on a risk-adjusted basis is very sensible. And also from a return on capital employed, it's very, very positive. So the second opportunity, Refresh, is in effect a redevelopment, refurbishment and repositioning initiative of existing student and private rented residential stock. It will often be ESG or building safety led, with key upgrade works needing to be completed, but can also include full refurbishment and repositioning of an asset. So again, why I like it, Watkin Jones can utilise existing teams and skill sets from the Fresh market insights and analytics, our delivery team's scale, track record and buying power, and our building improvement team's specialist expertise to to provide a full development service offering to clients. We think the scale of demand is potentially significant, with a considerable proportion of the existing UK PBSA stock being older and poorer quality. There's also scope in existing residential assets, which are trying to bridge the gap to their sort of more modern build-to-rent counterparts. I also think there is relatively limited competition on a like-for-like basis for Watkin Jones here, and the wider spectrum of projects can allow scalability and also more granularity to the business earnings. Alongside this, a refresh model would also enable swifter revenue recognition, as typically projects will not need to go through a lengthy planning and sales process. So look, whilst it's an early stage, we do have the existing teams in place and are already in discussion with a number of our key investor client base and universities about potential projects. And just to illustrate it really, what this could look like, this is a live case study which we are currently negotiating. It's not secured, and so we're not sort of over-promising, but nevertheless, it's interesting. And it's an existing halls of residence of 700 units, and Watkin Jones are the preferred development and delivery partner. The building needs full recladding and fire stopping works, and as well as other inherent building defects. It also has an ESG angle. They want to reinstate the building to a BREEAM Excellent rating. And then in order to pay for these works, because these can be quite costly, they're looking to effectively reposition the assets by refurbing the bedrooms, the kitchens, the communal areas, and changing the price points of the asset. So, for us, this is a live example. It's actually, attractive levels of revenue at circa 30-35 million. And again, the revenue generation could be a lot swifter. So the last slide, I'm not going to dwell too long on this because we don't think we're in the right market at this exact point in time to consider this, but nevertheless, we're keen to let people know of some of the wider thinking and where some of the longer term opportunities could lie. And this is really exploring the sort of wider asset management roles for Watkin Jones in partnership with our investors and their capital. So in a stronger investment market, we do believe there is significant potential to generate incremental fee income through partnership vehicles and asset management services. Alongside this, these structures could offer Watkin Jones alternative funding solutions, fee income and property management opportunities, as well as the ability to share in potential future outperformance of the assets, which is something that we don't benefit from at the moment. We see this as an extension and maximisation of our existing in-house specialisms and a chance to catalyse our existing developments and operational models without cannibalising them or without moving away from our core sort of capital-light structure. This will be brought back to shareholders at the right juncture if we think it's got sort of further merit. So, look, in summary, we absolutely believe Watkin Jones remains a market-leading business, despite the challenges that they haven't diluted our expertise and our place in the market. I think we're a business full of resilience and agility, and I think that's been demonstrated time and time again. And I think the model we have just offers an inbuilt resilience. We're performing in some of the best real estate sectors in the UK. I can't think of any others I'd rather be operating in at the moment. And I think that the management team, Sarah, myself, and the wider team, look, we've spent a huge amount of time really just kind of control the controllables within the business and really focus on how we can get that absolute performance. I think there's a real depth of expertise and knowledge of both the markets and the development markets within this business, and that's our real strength. And then also, look, we're looking to see where there are opportunities to broaden and diversify our earnings. We're not looking to stand still. We're looking to move forward. So I think with that, we conclude the presentation. Hopefully that's been informative, and we can move to a sort of Q&A.
That's great. Alex, Sarah, thank you once again for updating investors. I will just return your cameras back up for the Q&A. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the guys take a few moments to review your questions submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. Alex, Sarah, you've received a number of questions throughout your presentation. So firstly, thank you to everybody for your engagement this afternoon. Alex, if I may just hand back to you, ask you to open up that Q&A tab, and then if I could ask you just to read out the questions and give a response where it's appropriate to do so, and then I'll pick up from you at the end.
Sure, no problem. In no particular order, I'm just reading them as I see them. Okay, so the first question, what sort of contract could the refurbishment opportunities be under? Would this be cost plus margin or a fixed price? If fixed, who would bear the risk of funding additional unexpected works? Okay, yeah, good question. Look, I think in essence, this would be, very much the normal form of contract that we'd use. It'd be under a development agreement, which would then also have a sort of build contract alongside it. In terms of sort of cost risk, ultimately, as a developer, we would bear that. But I think what's really important, firstly, is setting the scope. We're going into these projects with eyes wide open. We've done a lot of our own remedial works and refurbishment works. We do understand what to look for in these buildings, but we also understand what we can't see. So the key is setting the scope correctly to make sure that you understand what you are prepared to take that cost risk on, and the elements that you aren't. And those that you aren't, you effectively you have to agree in partnership with the university or the investor. I think it's also important to note, clearly, if we take on a job like that, we subcontract the packages out and in turn pass the cost risk down to the person taking on the subcontract. So you do effectively offset your risk in that sense. So hopefully that answers that question. I think that's okay. Yes, that's perfect. Okay, so Alex, in terms of the refresh redevelopment opportunities, is this something that you could see happening this year, or is it something you're talking about with parties, but is probably more likely to make a contribution in 2025? Yeah, the answer to that is we are live with this at the moment. I think, again, why I'm quite infused by it is we don't need to do any costly acquisitions for the group. We don't need to bring in any external skill sets. They're already there. So we are already in live conversations on both of them. In terms of our budget for the year, we haven't made significant allowances at all. I think, look, I'm very conscious. I don't want to make a big splash about this and put really big figures out there until we've got real confidence that the market is what we think it is, and that we can really take advantage of it. So there's minimal stuff in the figures at the moment, but I do believe that it would be very nice to secure a couple of projects this year, and that's certainly the aim. The question on margins. Do you see gross margins in the long term returning to 15 to 20%? Look, I think certainly at the moment, the new sites that we're acquiring are building back towards that level. I'd say we're probably 2-3% off those at the moment, and that's where it's sitting, which we still think is an acceptable return. I would like to see them sort of push back there. I think everyone just needs to sort of just see how the markets react to, do I think interest rates are going to go back to pretty much zero? No. Do I think they're going to drop? Yes. So I think we just want to see how that plays out. But yeah, look, we're certainly looking to get much closer than the sort of, I guess, the blended 10% or so that we're seeing at the moment on the older stock. Okay, let's have a look through. I'm trying to find one for Sarah. This one, I just want to make clear, because it says your results state that you've not made a provision for cladding, fire safety, remedial works. So just to reiterate, Sarah, just in case this person missed that part of the presentation, do you just reiterate that we have made provisions and what the forecast spend down is this year and next?
Yeah, sure. So last year, so in FY22, we made an exceptional provision of 33 million for cladding works. I think we anticipate, and there's a couple of questions here, so maybe I'll pick them up in the same answer. We anticipated at that point that would be spent over the next 5 years. So you would say on average 7 to 8 million a year. We have obviously spent more than that this year. We spent 15 million over the course of the year. And this is obviously, for some part, the rationale behind we've had to increase our provision by 35 million this year. As I set out, the increase is effectively due to a number of buckets. First is the evolution of government legislation and effectively the publishing of the second legislation. We did sign up to the government's responsible actor scheme during the year, which obviously covers all leasehold properties that we built over the time as Watkin Jones has been in business. We also had to take an additional provision for an increase in costs and scope on properties that we had provided for last year. And this was as a result of intrusive surveys and fire safety reports that we had received on those. We did, as we were again set out, manage to achieve some settlement negotiations and therefore some settlement contributions from building owners during the year. So the provision is effectively is netted off or is netted off against those. I think there was a question here about can we value what the potential future recoveries could be from the supply chain. I think at this point it's something we are very, very active in, but we're not able to put a value into it. But obviously we will update next year in terms of our success on these. I'm just seeing, Alex, if there are any further.
Yeah, there's just one. Is the remedial cladding work tax allowable?
Yes, it is.
Okay. Good. So I think that's covered most of those. Okay, let's. Okay. I guess I should probably take this one. The company's track record with its forecast has been unreliable in the past. As a new CEO, will future forecasts be more balanced? Look, I completely understand the question. You know, we've had a number of downgrades over the last 18 months or so. I'd like to think actually before that the forecast had really been quite accurate. You know, we prided ourselves on hitting our targets, and you know, in a slight defence, I'll say that we've probably been through the most hostile environment I've ever seen for being a developer in the UK over the last few years. I think every single headwind possible has come at us. Nevertheless, you know, I think we as a management team and business are for, you know, perhaps we were a little bit too optimistic in how market recoveries might play out, and the tone I'm trying to strike and Sarah's trying to strike, look, we're incredibly passionate about this business. I really believe in the business's strengths. I really believe in the markets that we operate in, and I do believe the market will come back. So I'm trying to very much get that across, but I'm also very conscious I don't want to overpromise. You know, we can't control the economy and we can't control, you know, the wider inflation piece. So we're trying to be much more circumspect, and hopefully that comes across and lands with people and they understand it's us just trying to be the right side of caution. So hopefully that answers that question. Sarah, one for you, just on how much of the cash spend on the restructuring costs of 3.1 has already been incurred and how much will fall into FY24?
Yes, of course. So we've incurred all of the cash restructuring costs. So that all went through in FY23. So nothing further to come in 24, but obviously the savings will come through.
Okay. And then also, do you want to pick up this one? Please elaborate on the loss of 6,800 student beds in Fresh in October. How many clients left, and what are the average contract periods of remaining clients? What steps is the business taking to secure existing customers for the longer term?
Yeah, no, of course. So the 6,800 beds that we lost at the start of October were all in relation to one client, which effectively took the operation of those rooms in-house. We did manage to mitigate it at the time with an additional 3,000 beds. So the net loss position to us has obviously been 3,800. As I said, we are looking at we've got a current pipeline of 7,000 plus, some of which we would forecast would come in during the year as we would take over the schemes, some of which would come through at the start of the next academic year. Currently, we've got 28 contracts or clients effectively, and obviously that covers about 71% individual schemes. Average contract length remaining would be within 2 to 3 years. So there's a level of security of income there. In terms of what we're doing to make those contracts more sticky, which I think was the question. This is effectively looking at, for example, a level of the kind of additional services that we can build around the management fee model. Just trying to make the service that Fresh offers a very, very integral part of the building and the operation of that building.
Yeah. Sorry, Sarah, you seem to be hogging the mic here, but in terms of slide 15 and the proportion of operating profit to be secured, okay, how many of the 4 sites you mentioned would be needed? Okay, I can cover that one. So look, in terms of sort of trying to achieve guidance for FY24, we've got 4 sites in the market, one of which is quite advanced in terms of a sales progress. And then we've got another 4 or so in relatively well progressed in the planning process. And they could potentially come through, if we got planning in the year, they could come through and contribute by being sold. The reality is there's not a sort of one answer. There's not just 3 assets or 2 assets or 4 assets. It all depends on the pricing we achieve on them, the point of time in the financial year that we achieve the sale. So and the assets in particular, because they've all got different characteristics and sizes of site, etc. So there's not a simple answer. Say we just have to sell 1 or 3, but it's this combination. But again, look, we've looked at it and we feel we're being sensible in our abilities. That's why we're maintaining guidance. We think we've got good assets and we are reliant on the market. We do need the market to keep on that sort of positive trend that we've seen very early signs of in order to achieve those. But that's why we're sort of sticking with our guidance and believe it's very much achievable. Okay. Sarah, do you want to pick up this one? What events will allow you to restart dividends in FY24?
Yeah, sure. I mean, from a dividend perspective, as I set out, it is very much our intention, if markets and if our profit allows, to return to our progressive dividend policy. And we used to have a 2 times earning cover. I guess the caveat to that is we need to review the recovery of the market over the course of the year, and equally just be conscious from a cash perspective whether it's the right thing to do with the business. But as I said, very, very much our intention at the moment, but obviously we'll keep closely under review.
Okay. What space heating is being installed in your projects? Probably haven't got the most too technically minded people, but I'll pick this up. If it's mean generally what sort of heating sort of systems that we're sort of putting in, typically now we're sort of looking at air source heat pumps across all of our schemes. So we're trying to sort of really boost our sort of ESG credentials on that. Every now and then we do need to tap into district heating systems, and that is very much driven by the local authority in wherever city or town the asset is located. But we've very much moved away from CHP plants and are focusing on that sort of air source as the primary. Interestingly, we have started adopting localized air source heat pumps as opposed to sort of major single plant ones, but actually putting them in individual apartments, which is again has better environmental credentials. So we've started trialing that on some assets as well.
Alex, I might just jump in there, just on the basis that we're coming up to time. It looks like you've taken most of the questions there, if not all of the questions that you can from investors. I don't know if I've jumped in a tad too early, but if there's nothing further to add, then thank you. That's perfect, Alex. Sarah, thank you very much for updating investors. And of course, we will publish these responses once they've been transcribed on the Investor Meet Company platform. Alex, Sarah, I know investor feedback will be particularly important to you both, and I will shortly redirect the investors on the call to give you their thoughts and their expectations. But I wondered before doing so, Alex, if I could ask you just for a couple of words just to wrap up with, and then I'll send investors for their feedback.
Sure. No, look, just thanks very much for everyone's time. I mean, hopefully, we have got across. I've worked in this business for 13 years now. I've not quite man and boy, but I've been across the business when it was owned by the family. I was part of the float that floated the business, and now I've got the honour of being CEO. And I am passionate about it. We want to get the results back on track. We want to drive the business forward. We think we're making the right decisions. It's not easy out there, but we're navigating it, and we do have good positivity in terms of that sort of medium long-term outlook in terms of where we can take this business. So hopefully that came across today, and we welcome your feedback.
That's great. Alex, Sarah, thank you once again. Ladies and gentlemen, please don't close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that management can better understand your views and expectations. It's only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Watkin Jones PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thank you.
Great. Thank you.